Welcome to the Top 10 Ways to Build Credit with Consumer Loans webinar. If your screen is not loading, please refresh your screen. Please make sure your view is in participant mode. I'm Patrick Donahue, Marketing Coordinator with Congressional Federal Credit Union, and your moderator for today's presentation. Congressional Federal Credit Union provides innovative and affordable financial products and services, education, and community outreach to the Congressional FCU family, which includes the House of Representatives, Congressional Support Offices, and functions on Capitol Hill, in addition to affinity and non-affinity select employment groups. Established July 9, 1953 by 8 congressional employees with just $40 in deposits, we have grown to over 47,000 members and still counting. Congressional Federal has developed a reputation as a trusted credit union based on its proven track record of reliability with its members. Our presentation today will run about an hour, including time for questions and answers at the end of the presentation. Feel free to enter your questions into the pod to the right of your main screen. We will be collecting them for the Q&A period. This presentation is being recorded, and an archival link will be emailed to you within the next couple of days. Today's presenters are Nicole Collier, Senior Loan Officer with Congressional Federal Credit Union, and Luis Jara, Consumer Lending Operations Manager with Congressional Federal Credit Union. And now I'll turn this presentation over to Nicole and Luis.
Thank you, Patrick. Welcome everyone to our webinar. It's a pleasure to have you today. Now I'm going to turn it over to Luis Jara so that he can talk to you about today's objectives for our webinar.
Welcome everyone. Good afternoon. This presentation will basically go into the following slides. The objective of the presentation is basically to build healthy credit with smart financing solutions. The presentation will cover basic consumer lending concepts with tips that can be utilized in ways that you can build and strengthen your credit. First, we're going to have a basic understanding of the products offered at various financial institutions. And with that in mind, we're going to go ahead and start with the most common one that we typically hear about is basically personal loans. So personal loans, they can be defined as installment loans granted for personal use, usually unsecured, with monthly payments, typically set up to 5 years. But we might have seen also some others that are not so common, but 7 years as well, and that could, it's also an option. It's good to recognize and distinguish something that is very important when applying for a personal loan and what type of personal loan you're applying for, whether it's fixed or it carries a variable interest rate. When it comes to a fixed interest rate, you have the interest rate that is set for life. Basically, let's say it's like 9%. You have that for 5 years. You have a set monthly payment. Imagine it's $200 per month versus a variable interest rate loan, which the interest is going to change over time, and that the payment of $200 may be either can go down $190 or it could go up $220. One thing to keep in mind when it comes to that variable interest rate loan, if you have automatic payments, let's say you have that $200 going there every month, and then if you happen to be having a variable rate loan, the rate goes up, and then your payment of $200 may not fulfill that monthly requirement that is any month. So maybe it's something to keep in mind that you could be late for those $10. So and that rate actually for the variable rate it changes. There's an index associated to that, and that's basically either could be prime or LIBOR. Now with personal loans, we have there are some features associated with those. There's the flexibility in the funds usage. So what I mean by that is basically when you apply for a car loan, a boat loan, a motorcycle loan, you're only using that to buy that particular car, boat, or motorcycle. But when it comes to a personal loan, you can use it for, a number of things, different purposes. There's a lack of collateral, so it's an unsecured loan. You don't have to have an asset to basically apply for that loan. It's easier access. The funds may go to your checking, may go to your savings account. We can, institutions can cut a check payable to you, if you're consolidating, to the other credit card companies. And it's relatively quick decision. So by that, it's not extensive. It's not a mortgage. It's not a home equity loan. Basically, you're not applying for that. So when it comes to documentation, you may actually typically seeing you submit income verification, and it's pretty quickly to get a decision, and then you sign the loan agreement with the terms of the loan. Common purposes. The big one here is a major one, and the most popular, I would say. It's basically a debt consolidation loan. So obtaining that, it's consolidating credit cards and other things that you may have on your credit report: wedding, vacation, home renovations, taxes, something that is typically unexpected. For instance, like comes to tax year and that tax month season, that you may be, may end up with a huge tax bill. So something you can bridge for that and pay it. So it's just basically overall personal usage for personal loans. And the disadvantage of that, it's not a major thing, but because the lender relies on your good credit and the ability to pay, and because it's an unsecured loan and you have a higher interest rate than is typical. So that's just kind of a disadvantage, but that's kind of one of the only thing. Things to keep in mind, to be mindful of on personal loans. There's a maximum amount that is set by the lender. So, when comparing with different institutions where to apply, find out, whether the maximum is $25,000, $30,000, and if you have, something that you want to consolidate for $40,000, they may not be able to satisfy what you're looking for. So just something to keep in mind, what those maximum limits are, and something that recently, we've seen also, if you open an account, savings or checking with another financial institution, they may restrict you or prevent you from applying, I guess, until like 6 months for a consolidation loan, for instance, just because they may actually want to see how you're managing your account. So it could be 3 or 6 months. But also origination fees, that's another thing to be mindful of. And this is basically what the lender will charge you when dispersing the loan, when funding the loan. It could be 1%, up to 5%, and this typically you may see that on online borrowing. You go to a website and you to another lender. Just keep in mind, be mindful, open your eyes, about those finance charges. Let's say you get a $10,000 personal loan, and then they charge you a 4% origination fee to disperse the loan, which is like $400 already there, basically. So keep that in mind. Prepayment penalties. It's less common nowadays of those type of penalties. Those are exit fees. As you're trying to pay off that loan that you have for 5 years, in 2 years, let's say you get a big tax refund and you're trying to pay it off. Just ask questions. Keep that in mind, and just something to look out for. So.
Okay, so our next topic is secured loans. This is a product that a lot of consumers will turn to when they want something that is usually less impactful on their credit, but they still need access to funds for any of the purposes that we've named up to this point. But just to kind of break down some aspects of the secured loans, this is a loan where a borrower is pledging an asset as collateral for the loan. So that means that this is definitely being anchored by something that you have, and most commonly people are using their share secured. Share is another term that equates to a savings account in credit union culture, but their share or savings certificate, as in certificate of deposit, and in some cases individuals may be able to use a vehicle that they have that is lien free, that they own outright, to secure some funds for themselves. Now, the first two options are usually provided without a direct impact to your credit as far as evaluating your credit worthiness to obtain it, because you are putting money up front to secure the loan that you want to borrow against, and they usually have some more flexible payment options outside of your standard, once monthly payment. Some of these items may have payments due at the maturity of the loan, so that could definitely be beneficial to your bottom line if you have a 3, 4, 5-year term, and you have the option whether you want to pay this monthly or just provide a lump payment at maturity. With the last option with free and clear title, you definitely have to make sure that there are no liens on that vehicle, and that also the value is there in that particular vehicle that you are selecting to support your loan request. So those are the major aspects of the secured loan products. Now, some advantages. Because it is a secured product, you are looking at lower interest rates in comparison to your personal unsecured options. It can definitely save you money because of those rates being lower, and also because of the options that are available to you for repayment depending on the particular product that you choose. Credit builder. We discussed how secured loans do not necessarily require you to prove your credit worthiness in the options provided, with a share secured or certificate of deposit secured. But the benefit of this product is that it will report to the credit bureaus your timely payment. So this is definitely a tool that beginners who want to build a solid credit history can usually turn to help get them started. That $500 you have in your savings, you could use that for many purposes and still at the same time have something that is reporting a positive payment history on your credit report. Also, it's a lot easier to obtain these type of loans, especially because of the collateral that is associated with it. Those loans are definitely less risky because definitely if you're putting up $10,000 in a savings account or a certificate of deposit, most people want to make sure they get that back. So it definitely has less risk associated with it compared to an unsecured personal loan. And as discussed when we're building credit, lenders may be more considerate when there is a collateral versus a personal loan, as we discussed, because most people definitely want to maintain their ownership in those products that they're putting on the line for this. Now, disadvantages. The loan amount is definitely dependent upon the collateral value. So in those particular types of loans, you can't necessarily obtain a $20,000 loan if your collateral is not there to show that the value is there before that $20,000 that you're asking for. So it may not always be the best option if you're looking for something, a bigger ticket loan, something that's going to cover a lot of things financially, because you definitely have to have the funds there or the value there in the vehicle. Things to be mindful of, just like with our personal unsecured products, there could potentially be origination fees or prepayment penalties. It's not always common with our secured options, but you definitely want to be aware of what this particular loan entails with the lender of your choice.
Yes, and another common lending product is basically reward cards, credit cards. They typically carry an incentive, and that incentive is, comes from the purchase of, doing transactions. You get cash back, which is the most popular, everyday expense. Basically, you can get cash back on purchases that you do, miles and points, and those are the other ones as well. So who are the best candidates for reward cards? A few things that we have to consider basically is just you have to have the determination to avoid overspending. You have to be disciplined in keeping within your budget what you are using every month. Another thing is that you have to pay off your balance in full every month, and we'll go into the details of that. So there is the consistency that needs to happen when when it comes to that, who's the best candidate. And then you also put a lot of spending on the credit card versus paying that in cash. So I mean that seems easy, right? I mean basically you're buying groceries, gas, everyday items, but make sure to pay it back, and that's also within your budget that you don't overextend on those the usage of the reward cards. Things to keep in mind. A few things right here. With the expiration date of the introductory rate of that brand new credit card, you could have 0%, and then it could reset pretty soon with that new credit card. The expiration date of the points, do they expire in a couple of years if you don't use them? Do they go away, or are they stay forever with your card? The annual fee is typically high, so find the ones that have or carry the lowest annual fees, or simply none at all. And you have to put it into perspective, basically, how you are spending that using that credit card versus the annual fee. $75 is what your annual fee is on that particular credit card, and the utilization of that credit card, and the points and the cash back actually that you're getting, it's greater than $75. It might be interested at looking into that. So just kind of offset, like, okay, well, how do I just do the math, basically? It's the bottom line on that. The interest rates, they're pretty high. So, and this is what I was mentioning earlier, avoid carrying a balance, paid off every month if that's something that's, an option for you. And then you're the best candidate for that because you're, utilizing that credit card, taking advantage of the cash back, and also paying it off, and you don't pay any interest at all. Not everything is 5% cash back throughout the year. What I mean by that is, there's some seasonal every quarter. Certain things are 5%, everything else is 1%. For instance, like restaurants and groceries, gas and home goods, and they rotate, and there's certain promotions during the year. The limitations on the cash back, 5% cash back, can be only up to a certain amount. It can be up to $1,500 of their spending amount, and then after that, it's back to 1%. So keep comparison of those credit cards. Cash advances is another thing to keep in mind. Your credit card is not a debit card. When you do a cash advance, there might be some other higher fees associated with that, and you accrue interest from day one. So even if you try to pay it off by the end of the month, you're accruing interest anyway. So just keep that in mind with the cash advances there. So.
Okay, so now that we provided you with Consumer Lending 101, the introduction to the products that you use to help manage your credit, or in some cases build your credit, let's talk about how you can use these items and these products to strengthen your credit portfolio that you have. So the first topic is credit card utilization. Well, if you have a credit card, the goal should be to have a zero balance every month. But we understand for most consumers that may not always be an option, especially if you have to rely on a credit card to buy a big ticket item or pay for a pretty hefty expense. So if you're not able to maintain a zero balance, try to keep your balance at 30% or less of the actual limit. Now, if you're like me, the very first thing that pops in your head is, well, if they gave me this limit, why do I only have to use 30% of it? Well, I wish I could honestly tell you the answer, but what I can definitely tell you is that having a heftier utilization rate on your cards impacts your credit score pretty badly. So anytime it starts creeping above 30%, you will start to notice the rollback on your score. So maintaining those lower utilization rates across all of your cards It will definitely help your score to grow each month, and it also shows a solid balance in how you maintain your accounts and keep up with the debt that you are acquiring. The next topic is credit inquiries. What I've found through my career is that a lot of our consumers just aren't familiar with the impact of credit inquiries. That's pretty much any time that you have someone pull your credit for an application to see if you qualify, that is going to be listed as an inquiry on your credit. There is no magic number to credit inquiries. However, the fewer there are, the better for you. One thing you definitely want to keep in mind is that if you are applying, with a lot of different lenders for, approvals, it can definitely be viewed negatively to any potential lenders. They want to question, is this person desperate for credit? What's their situation? Now, another aspect of credit inquiries that most people don't realize, they stay on your credit report for typically 2 years. So, that one thing that you applied for that you didn't really need, you get to the cash register of your favorite store and they tell you, oh, you can save 20% today by opening our card. Well, you might have applied for that card. If it wasn't something that you truly, really needed, guess what? You're paying the price on your credit report for at least 2 years because that's how long it's going to be listed there. Now let's talk about soft versus hard pulls and how that affects the credit inquiry balance. Soft pulls are, let's put it this way. When you get those invitations in the mail that says you are pre-qualified, you are pre-approved for this wonderful loan, this wonderful credit card with this fantastically low rate, that's a soft pull. That means that they have received some information about you that makes it seem like you are an ideal candidate. However, they can't really confirm whether or not you do have the full credit worthiness that you would need to qualify for that fantastic rate that they're, tempting you with until they actually do a hard pull of your credit. Hard pull means that they are pulling the full report. They are evaluating your credit worthiness. They're looking at your history, your score, and that is definitely having a stronger impact on your credit report. Soft pulls don't impact the score, hard pulls do. So just make sure before you give that permission or authorization to submit that application, because I want that 20% off on my purchase, make sure that it's really worth it. And if you're in a situation where you're trying to improve your credit or build credit for the first time, you definitely want to make sure that you're only using your credit for necessary things. So we did talk about how those excessive inquiries may be viewed negatively by lenders. So just keep in mind, the best rule of thumb is if I really don't need it, I'm not going to have them pull my credit. The last topic is diversifying credit. A lot of people don't understand that it's important to have a healthy mix. Most individuals start out their credit portfolio with some type of student loan. Well, I hate to break it to you, student loans don't carry that much weight as far as helping you build credit. It will definitely hurt you if you're not paying your student loans, but when you're looking at the other options available to you, that first auto loan that you get, that first store credit card that you get, those items definitely help to establish a full, healthy, solid credit portfolio. But you want to mix that up. You don't want to have just credit cards and just revolving lines of credit, because if you're not showing a mix of fixed versus revolving credit accounts, you're not really showing that you have a solid credit report and you have a fair understanding of how to manage the different types of credits that are there. Just keep in mind with any credit account that you have, the older it is, the better it is for you. You definitely want to have accounts that you've had for at least 36 months or longer, because that definitely helps to solidify the strength of your credit history. So just keep that in mind. If you do have a card that at one point, it served a great purpose, you use it all the time, maybe you've paid it off and you just don't use it anymore, it might be okay to dust it off every once in a while for a small transaction that you can pay right off, just so that you can keep that account growing and aging on your credit report. Doesn't necessarily mean you have to carry a balance with that, but just by using it periodically, you're keeping it active as far as on your history. And like I said, the older the account is, the better. So that'll definitely help you by having that account there in excellent standing when you go to apply for that new card or new personal loan that you need.
All right, and talking about that, you mentioned a couple of interesting points there, some keywords, building and strengthening your credit. So we have the authorized user and joint account owner. So to choose which one should I be the person who's just the authorized signer of the credit card, or should I be the joint account owner of the credit card? So just to put them side by side here, the authorized user may not have a huge impact on your credit score. That credit card that you are signing up for. The authorized user, is not responsible for the repayment of the debt. So you could be making the payments as an authorized user. You can be learning, you can be managing, you can be very disciplined in doing that, but it may not impact your overall credit history. And you're actually subject to the primary account holder's credit habits, basically depending on the utilization of that person who is the main driver of the account. And the authorized users can be removed at any time, just any point in time, basically. So, and then on the other side, we have the joint account owner. Basically, it has a huge impact on your credit score. Both parties agree to share the responsibility of the credit card that is being taken. It's a good way for both account owners to build and maintain credit. And then basically both actually have access to that credit limit. For instance, the person with the lower credit score, somebody could have a 650 FICO score, and then the other person would have a 740. So you are basically getting access to, it could be a higher credit limit, it could be a much better interest rate because of the other person also associated with that account. Just by you being a joint account owner, you're responsible for those payments, and lenders tend to view that joint account owners versus authorized users, just building and strengthening the credit more favorably. So now with authorized users also, you may have what is called sometimes an inflated credit score. And that happens because it could be associated with a teen credit file. And a teen credit file, it's basically somebody who's starting to build new credit, somebody who's obtaining their first credit card. You could have a credit score, you could not have a credit score, but you don't have a lot of, what Nicole was mentioning, a mix of accounts. And you typically see those on the new consumers who are trying to establish credit, and you also sometimes see that on the people who don't have any other credit cards, but they're homeowners, and that's the only account that they have, and that's basically you only have one trade line, you only have one account, the mortgage or a home equity loan or a line of credit, and nothing else. And when you're applying for to obtain a credit card after several years of not utilizing credit, then you may not end up with the most favorable interest rate. So just keeping that in mind, joint account owners is the way to go.
Okay, so now that we've talked about these products, we've talked about authorized users versus joint account owners, now we need to talk about determining which lending product best satisfies your needs. So when it comes to determining the amount that you need, that means that you truly need to assess your project or your expense, because when you select the loan amount, you definitely want to make sure you're not leaving anything out. Now, when you are consolidating, you definitely want to look at your full portfolio of what you have and who your lenders are, so that you make sure that you're taking advantage of the consolidation to the fullest, and you're not leaving out that one little pesky account that you really could have rolled into your consolidation or your balance transfer. Determining payment affordability, that definitely equates to, does it fit your budget? One thing that people have to be mindful of is that your budget is everything. So you have to be exact with your numbers, making sure that your payment fits in perfectly, and you definitely want to make sure that you're leaving room in your overall budget and not kind of maxing yourself out when it comes to your income versus the debt that you'll be paying out for acquiring this new loan product. And once you actually determine the amount that you need and your affordability, the next step is determining whether or not this is something that you'll need again or if this is just a one-time thing. So that will help you decide, do I need a credit card? Do I need a personal unsecured loan? Maybe I should do that share secured that we talked about, or that certificate secured, or maybe I'll borrow against my free and clear title vehicle that I have. So based on the amount, based on the frequency of the need, that will help you determine, okay, maybe I need something fixed or something revolving.
All right, so another point here is, comparing rates and, checking different lenders and finding out what they offer. And before also doing that, have to be mindful of, checking your credit. See where you stand. Know what your credit score is. One of the things that basically I'd like to point out is visit annual credit report. This is basically a source that is authorized by federal law that you can actually get a free copy of your credit report, and from all different credit bureaus, Experian, TransUnion, Equifax, and yes, it's free, of course. And one thing there, you may not be able to get your credit score, but at least you can see what you have, and that's going to be very important because you can find out if there are any inconsistencies or any derogatory information that you didn't know about. See if they can, if that's the case, see if that can be fixed before applying for that vehicle loan. If you need to apply for that loan that you're looking for, then if you paid it off recently, it's not going to update on your credit report right away. It doesn't happen overnight. It may take up to a month perhaps to get updated, but can you support it with documentation that you paid off that derogatory information that you didn't know about? So research the lender and look into their fine print about the rates, the terms, any hidden fees that we mentioned before, like origination fees and things like that. Ask the lender what credit bureau do they use. For a simple personal loan, credit card, auto loan, lenders will not pull all three credit bureaus. They're only going to be basically just using one. It's not a mortgage. It's not one of those big loans you're going to be getting. So just keep that in mind. You can ask the lender, are they using TransUnion, Equifax, Experian? And one of the things to keep in mind also, just if you have a credit freeze lifted before applying, I know lenders see that, and that may sometimes slow down the process a little bit in getting the funds that you are looking for. And it's good to be protected, and by all means do what you need to do to have that credit freeze on your credit report, but lift it before applying, and then you can put it back again. You can do a global lift, and you can actually obtain a number, and then you can give that number to a lender, and they'll just key it into their system, and they'll just access that for that particular purpose. So just it will may speed up the process. It'll go a lot smoother versus maybe it will not slow down. So.
Okay, so now we're tapping back into the area of credit affordability. How much credit can I afford? If you already have an established credit portfolio, you may have a healthy mix of some loans that you've had over the course of time, some credit cards that you may have opened with some of our major credit card providers. In some cases, you may have your favorite, retail store that you have credit with. And one thing that is for certain is if you are managing your credit well, making timely payments, and keeping up with what you have, your credit portfolio will grow. So we need to always be cognizant of what we have and to kind of rein things in sometimes when they're starting to get a little too much for us to handle. A lot of consumers don't realize that, that credit card that you started out with 2-3 years ago, that you don't really use that often. That limit may have grown maybe 2-3 times what it, was when it first started out. And you can actually reach out to a lender and say, hey, I want to reduce my limit. Now, keep in mind, if you do carry balances on other cards, reducing your limit on one card can impact your overall credit utilization. But if you are the type of consumer that pays off your debt monthly, or you're sticking to, previous advice that we gave of maintaining, balances of 30% of the limit or less, then you may be in an excellent position to kind of rein in those balances that are there that tempt us to spend and buy those big ticket items that we don't really need, which in the long term can actually hurt our bottom line because we're paying more for that credit each month. Now, one thing that definitely sticks with me, if you remember Field of Dreams, the movie, the phrase, if you build it, they will come. I'm using that to say, as you start building your credit or improving your credit, the offers will come. And boy, do they. I mean, it takes over your mailbox. You'll have more junk mail and offers than you could ever imagine because these other institutions are aware through their soft pulls that we've discussed, hey, this person might be a great candidate for our card. Doesn't matter if you need it or not, they're still going to send it to you. So we want to make sure that, are we really assessing whether or not we have too much credit already or not enough? So when those offers start rolling in, you may find a great opportunity to possibly consolidate some other debt. You may find an opportunity to do a balance transfer. But one thing you definitely want to do is make sure as you take on these new accounts and maybe trim down what you already have, just be very cautious of becoming overextended. Overextended basically means you're putting the squeeze on yourself financially. We all work hard for our money, so we want to make sure that every day on payday, all of our money is not going to pay this debt that we've acquired through our unsecured lending that we have. We want to make sure that we can manage those payments so that we're not putting ourselves in a position where we might have to decide who's getting paid this time just to take on a bigger debt or a bigger expense that pops up. So all of that falls under credit affordability, and it definitely comes down to being a balancing act, knowing when to be frugal and knowing when it's okay to step out there and take on a little bit more.
Now that's an important keyword, Nicole, that you mentioned, being overextended and when to recognize that. What are those signs of that I need to actually look into a consolidation loan? A few things over here that I want to point out. The introductory rate on my credit card is expiring soon, so you were benefiting from the 0% for 6, 12, typically 18 months perhaps. Now it's going to be jumping up pretty high significantly, up to 16%. So, hey, that is really a sign that, you still have that balance. What is my current rate versus the future rate? And the future rate is something that you can find on your credit card statement. So review the credit card statement, and typically it's like on the second or third page there. After your transactions and purchases, you're going to see that rate being reset, that is only temporarily. So something to keep in mind. Also, if you have too many payments that you're trying to keep up with, you have the fear of missing one payment. If you're missing one payment and you make a late payment there, then it could affect and damage your credit report as well, reduce your FICO score. If you have too many different due dates, you're carrying 4 or 5 credit cards. You have one on the 11th, the first of the month, the middle of the month, all over the place basically. So trying to keep that into one single payment. Another thing that I was thinking about, grace period. If you're actually making those payments during the grace period or just before, a little bit over the due date, so that's another sign for that you may need to look into consolidating those accounts. If you're making payments and then your balance still the same, so that's another sign. If 10%, let's say, of your payment is going only to principal and every 90% is going to interest, that's a sign as well. So your credit score, may not improve if balances are, very, very high and close to the limit, especially with the goal of keeping that, 30% of utilization. So what I do is basically recommend is when it comes to putting this down into perspective as far as like how to consolidate. Just do something very simple. It's not complicated. On an Excel sheet or on a piece of paper, just put like 4 items there: the name of the creditor, the APR, which is the interest rate, the balance that you owe, the monthly payment on that account. So you can put credit card number 1, you have the APR, and then the balance and the payment number 2, and then just keep adding those up until you come up with, oh my God, I have been making $510 every month on different due dates, and the rates are significantly high. So what do I do now? So one of the things that you can do, talking about one of those products that we covered earlier, you can consolidate, potentially get a very low interest rate in the single digits with a secure loan. Your payments would be very low, and basically total savings on this particular scenario, $202 per month. Now, that's if you have, let's say, a free and clear title with a value of $17,000, but you may have, one vehicle that you paid off before, it's only $10,000 as the value. You may not get $17,000, but you can actually kind of combine a couple of products there, do a personal loan for part of the money and do the other one as a secure loan. So you could end up with 2 loans, but or just one single unsecured loan payment, and that's keeping that once every month, as opposed to going into different areas, different times during the month. So a couple of things here to identify as you're doing this Excel sheet, and separate the unsecured versus the secured debt. You don't want to actually get a personal loan to pay off your credit cards and unsecured loans, and at the same time paying off that car loan, because that's going to have a high interest rate on the personal loan. So and then keep the student loan separate. That is totally separate from everything else. It's meant to be paid over time on the long term. So if you need to refinance it, yes, refinance it, but don't combine it with a personal loan. I would just basically consolidate that with another, just a student loan refinance, and that's how you can actually try to, keep things under control and manage your debt as well. So.
All right. So let's talk about balance transfers. We speak a lot about debt consolidation through the form of a personal loan or a secured loan. Let's talk about balance transfers. This happens every day. We get fantastic offers, as Luis mentioned previously, 0% for 12 months, 18 months in some cases. I don't really think I've seen a full 2 years, but if any of you know of that, let me know. But usually 18 months is the cap on that. And that actually can do a lot of good for you, especially if you do have a lot of smaller, credit card accounts, whether they're store credit cards, to your favorite clothing store, or whether it's one of your major credit cards, American Express or something like that. So definitely you can take advantage of those low introductory promotional rates, and you can consolidate a lot of things and catch up on your payments. So as Luis broke down in the previous slide, you may have 3 cards that you're paying more than the minimum each month, and you figure out your bottom line is, hey, I'm paying out $300 to these cards every month, and even though I'm paying more than the minimum, it still isn't putting quite the dent in the principal balance that I needed to. So by having a balance transfer to a card that's offering you 0%, you definitely are able to take those funds that you've been paying to those 3 separate accounts and apply one hefty payment to this one account and get that balance paid down a lot quicker, because you're not worried about the finance charge popping up every month and totally undoing your progress. So you definitely get rewards and points for different types of cards that you can transfer a balance to. You just want to read the fine print to see what qualifies and what type of options come with that particular card, because it may be in your advantage to switch to a card that is going to give you cash back, because that could be a reward that you have applied directly to your statement that helps bring down that principal balance regularly. So points, you may be using this card while also paying down a balance you transferred to accrue points that can help you with that trip that you're planning, or, redeeming merchandise. I know a lot of people are, loving the high-tech gadgets and things of that, and a lot of these rewards cards actually do offer a catalog where you can actually redeem a lot of those items just by making your everyday purchases. So those are definitely some of the pros in taking a balance transfer to help kind of manage some of the debt that you already have. But let's talk about the cons. So with balance transfers, there are usually balance transfer fees. The normal standard seems to be about 3% of the balance that you're transferring, but make sure you read the fine print with your lender just to see, how they break down the balance transfer fees. I've seen some offers where they're willing to waive a balance transfer fee for a specified period of time. And balance transfers aren't something that just happens with new accounts. Your current card that you have that you just don't use anymore, they may be trying to entice you to come back, and they may be offering you a fantastic balance transfer offer. So you definitely want to review that to see, okay, what else can I consolidate? And when it comes to balance transfers, in a lot of cases, you can transfer a lot more than just card balances on other credit cards. There may be options for consolidating some loans that you have to take advantage of that lower rate. But again, you just want to make sure that, you're balancing out the pros and the cons fully to make sure that, if you're going to pay a balance transfer fee, is it really worth it for transferring this amount for the length of time that you're being offered that low or promotional rate? You definitely want to be mindful of when that rate expires, because no one wants the shock of going from 0% to 24% because your 6 months, 12 months, 18 months have expired. So if you are going to take advantage of that particular offer, you want to make sure that the debt that you are transferring over, you can pay it off completely, or in some cases pay it down significantly, so that if you have to keep a balance on that card after that promotion expires, you're still in a good place with the payments that you would then be required to make. Now, let's be careful about opening too many cards. You can easily fall into this trap where you're just transferring from one card to the next card to the next card. Keep in mind, you're racking up a lot of balance transfer fees when you do that. So yes, you may be getting 0% for a fantastic amount of time, but there may be a deeper issue there if you're finding that you always have to rotate a balance to another card just to keep your payments within a reasonable range. So then you might want to tap back into some of the information we gave you about knowing the signs of when to consolidate, and maybe you might want to try a fixed rate product as opposed to doing a balance transfer on a credit card.
Thank you, Nicole and Luis. Now, at this time, we invite anyone with a question to please type it into the pod to the right of the screen. We will hopefully get to all of your questions, but if we run out of time, we will definitely respond via email. And looks like we have a question.
Okay.
All right, this one says, if I have a TIN file and I have a car loan, I have been paying for 18 months of the 48 months. If I refinance, will that improve my credit score? So, basically, there's nothing that will tell you, okay, well, if you apply, it's going to, basically improve your credit score. But one of the things that I would try to find out is compare the rate that you have right now on that auto loan, and then see if that's beneficial for you with the rate that is being offered by that lender, and also see if that vehicle loan can be refinanced. Sometimes financial institutions will prevent you from actually refinancing a vehicle loan. That's something to keep in mind. And And yes, and by applying for that vehicle loan refinance, if you decide to do that, you can also at the same time see if you can qualify for a credit card, and then you can expand, establish and strengthen your credit as well, and continue building credit.
One important thing to understand first is what gave you the thin file designation. Was it that you didn't have enough accounts on your credit history, or was it that your accounts haven't reached the age of maturity, is what we call them? So basically, for us, we're looking for that you've had at least 3 accounts. Not all of them have to currently be active or even open, just in your history. And that also the age of at least one of those 3 is at least 36 months or older. So we had a discussion earlier in the webinar about, the older your accounts are, the better. Unfortunately, student loans don't carry a whole lot of weight when it comes to having a solid credit portfolio. But if you understand what it was that made your institution designate you as a thin credit file, whether it's your accounts just weren't old enough or you didn't have too many accounts, that will help you kind of understand what you need to do prior to refinancing. So if it's an age issue and you're already, solidly within the term that you've selected for your auto loan, your accounts that you have plus this new auto loan may have already taken you past a thin file designation where you don't have to worry about getting penalized with a higher rate because of that anymore. But if it's an issue where you didn't have enough accounts, well, what did you have when you started? Did you just have a student loan and maybe one old credit card that you had from years prior, and now this is the 3rd account that you've had? Or is it that this is the first time that you've built credit and your auto loan was your very first beginning start? So you have to first understand that to then understand what potential options would be available to you should you decide to refinance. But honestly, from a credit standpoint, if you've been keeping up with your payments, timely payments, you're definitely going to have a positive impact on your credit report. But the more accounts that you have reporting for you in a positive way, that definitely helps solidify your report and can definitely change you being listed as a thin file. All right. So one other question that we had received prior to starting our webinar was, what products should you start with if you're trying to establish your credit? And I think that's a fantastic question. Depending on who you ask, you may not get the same answer because your situation is your situation. But ideally, a lot of individuals turn to secured products if they have that option, maybe doing a secured loan. Some institutions offer secured credit cards just to get them established. And as we discussed, a lot of those secured products outside of a free and clear auto loan, they actually may not require a credit pull. So they understand that that product is tailored towards giving you the benefit of having monthly credit reporting without having to, determine credit worthiness prior to actually being able to offer you that particular product. Outside of that, I would definitely say, your first auto loan is definitely a great start. You may not start out with a fantastic rate because you don't have a credit history to really justify giving you that wonderful promotional rate that drew you in, but maybe after 6 months of, those timely payments, you can refinance and qualify for a much better rate. I actually went through that myself following college. My first car was 15%. I was just thrilled to have a brand new car. But it turned out, with that particular lender at that time, I kept the car for, I think, about 8 months, refinanced, and I was able to qualify for 0% just in that length of time. And that's a huge jump that I was very ecstatic about. I had no idea at that time, at that age, that making those type of timely payments could improve, my lender's view of me that quickly.
Yeah, and to add to that, just great points over there. And, the share secured loan, you don't need to have, basically credit for that pretty much. You can just save up, just some, let's say $500 and just, pay it back, and that's going to report on your credit report. Take a loan against that, the funds that you have in your savings. That's, as a starter, as a credit builder, it's typically the rates are low, and as you mentioned, you cover before Nicole. And a credit card also, you may not be able to get the $5,000 limit on that credit card with the best interest rate, but you can get $500, $1,000. That's how you can start building credit. As long as you have the ability to pay, you have some source of income that is stable, that is consistent, that people have to start somewhere, and that's even with the low limits like that, they can continue to build credit. So.
Yeah. And one other question that we have received prior to doing the webinar, I think can hit home with a lot of consumers. The question was, what do I do when I have too much debt to be able to get a consolidation loan? And that is a very tough thing to face, especially when you want to, rein in your finances, improve your credit by, making your payments more manageable, lowering your interest rates, and just keeping up with what you have. And the best approach that I can give to someone in that situation is, stay focused. Look at the things that you can combine. For instance, you may not be able to obtain that brand new loan to consolidate, but perhaps you have wiggle room in some of the accounts that you already have. So if you have a mix of credit where you might have some credit cards or some lines of credit, you may have some room to move some of those balances over to that particular product, target your payments, combine what you would have been paying for those two separate accounts to try to knock that loan out or line of credit out, and then you can combine that money and put it towards the next item, that you want to eliminate once you've paid that off. Now, it doesn't mean that you may be stuck having to kind of fend for yourself to manage this and consolidate on your own outside of, getting one loan that'll do it all for you, but that just may be the temporary Band-Aid until you're in a better position where your debt-to-income ratios have improved and you can now afford to take on this new payment. So one thing you want to definitely keep in mind is if you have a lot of revolving credit, a lot of lenders, even if you tell them up front, hey, I want to take this Visa balance and I want to, have it paid off with this new loan, you want to definitely see how they are calculating your debt-to-income ratio, because if they can't necessarily take it out of the equation until it's, showing that it's paid off in full, that doesn't really help you.
Thank you, Nicole and Luis. That wraps up our webinar, the top 10 ways to build credit with consumer loans. An archival link of this presentation will be sent to you in the next couple of days. In the meantime, if you have any questions, please do not hesitate to contact us. Thank you again for your time and attention.